Hello everyone, I'm Joel Schemmel, your host for Talking Trends, where we explore trends in real estate and other luxury lifestyle trends here in the greater Sarasota area. And today we're going to talk about one of those hot buttons in real estate, interest rates. Our special guest is Scott Kolbe, area manager for US Bank. Welcome, Scott.
Thanks, Joel. Thanks for having me again.
Great to have you back on the show. I think, Scott, obviously with US Bank, doing mortgages with US Bank, but a wealth of knowledge over the years. So tell us about your history in the industry.
Sure. Joel, I've been here, lending here in Sarasota area since 1997. So we've seen all different interest rate environments, all different, economies.
Yep.
Lots of changes to the area, the growth that's happened in the area. So yeah, we've kind of seen it all since 1997.
I know, it's amazing what you can cover in that many years, right?
Yes.
I mean, the roller coaster.
That's right, absolutely.
So let's kind of dive into it. I think interest rates, again, been a hot button for this whole year, but can you kind of take us through 2023 and what's happening as a cycle through the year?
Absolutely. So obviously the Feds have been really concerned with inflation. If you look at the inflation numbers, we started the year around 6.5%, reached a high of 8%, prior to 2022. And the Feds really wanted to get that back under control and target range around 2%. Mm-hmm. So we roll into calendar year 2023, 6.5%. Today we sit, 3.1%. And speculation projection is that by the end of this year, here in the next couple of weeks, we'll dip under 3%, be in the high twos, which is really close to where the Feds, wanted it to be.
Wow. Yeah, and again, I think it's been a kind of a bit of an interesting year, 2023, right? I mean, the real estate market itself kind of going through a cycle, obviously kind of tied into interest rates. So it's kind of, we've kind of seen coming off of 22 this high, and then maybe in 2023 a little pause, not a retraction, but a pause. And now I think as we're looking at the end of 2023 and 24, we're kind of seeing the market start to re-engage again.
Absolutely.
Which is super refreshing.
Absolutely. And I think a lot of that's driven by, the consumer, here's the word recession, and the Fed's trying to force us into a recession. They don't understand how that's going to impact them, real estate, their finances. But then as that kind of surfaced out and we saw unemployment numbers didn't jump substantially, we've seen unemployment move from 3.5% in December 2022 to 3.7%. We still have 155 million people working here in the U.S. economy. And so I think they've started to articulate that recession and kind of got over that psychological hurdle that this is not going to be a significant impact financially, and it's certainly not going to impact real estate prices. So they re-engaged buying. The dip in interest rates that we've seen late November and the first part of December certainly did help.
Yeah. I think, again, just a bunch of factors playing in there, but it's certainly helping the buyer mentality, for lack of a better word. So, obviously evolution of the market. Is there some part of the market that you're seeing that's more engaged, whether it's price point or product or anything that's more engaged?
Absolutely. We've seen the first-time home buyer kind of unfazed by it, especially now that rates are a little more affordable. Certainly when we touched that 8% range in November, it did cause a big pause for all sectors. But then as rates kind of trended down, as you mentioned, buyers re-engaged. First-time home buyers that need a property, they're kind of immune to the rate environment. They just have to buy.
Right.
We've seen resale real estate. Those numbers are down, towards the end of 2023, but new construction numbers are actually up compared to the end of 2022. So new construction market seems to be moving. Yep. And again, first-time home buyers and buyers relocating to the area are certainly in play.
Yeah, excellent. And I think, before we kind of dive into particular rates, I mean, there's so many factors out there, right, that are influencing the market. Obviously what the Fed does, inflation, unemployment, all those things. I mean, can you take us through a few of those and just kind of tell us how they're affecting the market and what kind of the outlook is?
Yeah, absolutely. And so we mentioned the two major buttons. You've got inflation and an unemployment data. We've seen inflation down month over month now, 3.7% month prior, which in November, 3.1%. We're looking at in December, and then speculation will be under that come first of the year. That's caused the Feds to come public with with not only pausing interest rate hikes, but also you saw 10 days ago, they said they anticipate having to cut rates more in 2024 than they thought, which the market reacted very favorably to in terms of interest rates. Interest rates tend to be a sophisticated market and move ahead of Fed movement. So when there's speculation the Feds are going to drop rates, interest rates drop, and vice versa. So that's what we're seeing right now with rates on a nice downward trend.
Excellent. And obviously there's other factors out there. How did the upcoming elections play in?
Elections impact every market, right? Real estate, the financial markets, and rates. So that should be interesting. I still think the biggest and most driving factor to the rate environments will be what these inflation and unemployment numbers look like. Specifically, inflation. Have they moved the needle enough? And it certainly feels like they have.
Yep. And I think the other thing that sometimes is very interesting, I'm not sure everybody understands, is you hit on it, is the Fed indicating future interest changes. And some people think it's just they wait for the Fed, and once the Fed does something, then the interest rates change. But it's not, right? It's in anticipation of those. And so even today, we're seeing some really good movements.
Absolutely. Yeah, the market tries to anticipate the movement, and then whatever happens, it just reinforces the movement that's already been sustained. So if there's speculation rates are going to drop, the rates will, begin to move that direction.
I love the background because I think we're all kind of fascinated at how these things move and what affects them. So I think we have a good feeling for that. So let's go just into interest rates.
Sure.
What is happening, conforming, jumbo, all those good things.
Yep, absolutely. Conforming rates, which conforming loan limit for 2024 was increased.
Yeah.
So we got a bump up into the about 760 range. The conforming 30-year fixed is in the low to mid sixes, 6 3/8 depending upon loan to value and credit. And then we've seen nice movement in the jumbo space as well. Jumbo 30-year fixed is down in the mid sixes. And then the ARMs, which still are very attractive.
Right.
Most real estate investors believe that the rates are coming down. So if we can get an ARM, an adjustable rate mortgage with a lower rate fixed for 5 and 7 years, it does make sense.
Right.
And those are in the low sixes today.
Okay. So again, nice movement because we were in the 8s, right, at one point?
Yeah, we did touch 8, and we did get above 8% there in November.
Yeah. We're talking about traditional mortgages for primary or secondary home. What are you seeing in the investment world or land lending?
Investment property is in the mid 7s right now. Lot loans probably similar price. And we do see some good activity in lot loan lending as people are wanting to buy lots and eventually build.
Right. And we see it obviously in the market, as you kind of indicated. Obviously new construction is often the favored flavor for buyers. They like that a little bit, because it's all new and it's new styles,
Sure.
etc. And obviously we are seeing more land purchases as well. So kind of may not be doing anything for a few years, but they may sit on the land for a few years and go into the future. So we're talking, in the 6s somewhere for most of our products at this point. How does that fit into the world of interest rates over time? Is it good, bad?
Still very, very good.
Yeah.
I think we definitely got spoiled during those COVID years when we had free money. Rates were very low. I think we got very, very spoiled.
Right.
I've been doing this since 1997, and rate environments of 6 to 8%, very, very normal, all through the late 90s, early 2000 range. So again, psychologically, I think it's a greater impact than it is financial.
Yeah. And I think that's the key thing. It is psychology for a lot of people, and it's kind of, to a certain extent, slowed down the market because it's just the mentality of changing from a 3 or 4% mortgage to a 5 or 6% mortgage. But I think in my world of looking at the numbers, since I'm an accountant by background, it's the same thing. Even if you pay a little bit more in interest rates, your land appreciation generally outweighs that over time. So it's kind of if you want to get in the market, if you really want to buy a house, buy a house. Don't worry whether it's 6% or 5%.
That's correct.
In the end of the day, it doesn't make that much difference. So, so as we kind of again look at the products that are out there and kind of what's the most popular, unpopular, either one really. Are you seeing some products that are really good for this environment versus others?
Sure. I think in the lower price ranges, say get anything under 800,000, we've seen seller paid buy downs be really popular, where the seller will contribute funds, maybe not negotiate as much on the price, but contribute funds essentially to the borrower's payment.
Right.
So we've seen the 2-1 buy down become very, very popular, where you have a start rate that's 6.5, but it's bought down to 4.5 for the first year, 5.5 for the second, then it resets. And again, we've seen that be very, very popular. Again, betting on interest rates coming down,
Right.
and by the time that we reach that third year, they've probably refinanced,
Gotcha.
out of that product. So that's super popular in that conforming loan space. In the jumbo world, interest only is a fantastic tool.
Okay.
Up to $1 million mortgage, you're saving in cash flow analysis about $1,000 a month,
Right.
which makes a significant impact cash flow wise. And again, ride out this rate environment and refinance at a better time.
And I think that's the interesting equation, right? I mean, you're seeing more and more of that, which it wasn't that popular of a product before.
No, I think the interest rate markets really have driven that. And again, creating better cash flow analysis for the consumer.
Yeah, and I think that's what's different, right, about this environment with interest rates. You're not, the reality is you're not going to get the best rate in the short term, but if you strategize as to what you'll do as the rates continue to fall, what happens in the next 2 or 3 years, and are you setting yourself up to take advantage of that environment?
Correct. Yeah, we anticipate seeing a pretty substantial refi market. And again, that old adage of marry the house, date the rate makes a lot of sense, because as our local economy changes, that real estate prices are going to go up. They're going to go up stronger than what an interest rate impact today would be. So get the property that you want now at the price you can today, refinance it over the next year, 24 months as these rates drop. Marry the house, date the rate.
Yeah, no, and I love that, and I think it's an interesting strategy. But I just have to add to that. Again, our buyers, a lot of second home buyers, a lot of, we're a resort market. I mean, enjoy your prosperity.
That's right.
Today.
That's
Don't
right.
wait a year. Don't wait 2 years.
Absolutely.
It's here now, and take advantage of it. So
Agreed.
That's always my recommendation to the buyers. If you
Sure.
find what you like, enjoy it.
That's right.
So,
That's right.
You deserve it, essentially. So obviously we talked a little bit about it, but forecasting into 2024, I just kind of like the scale of adjustments over the year. What's your feeling?
We definitely feel rates are going to come down. I think the feds have speculated to that. As to where, I think it all depends on how the inflation continues to move down. They've forecasted out a plan of inflation through 2025, 2026, where they want to see it to go, and I think they'll closely monitor that. But I think the significant impact to inflation is causing them to pause, and then also agree that rates probably need to come down in 2024,
Right.
so that we don't take this too far. And honestly, you don't hear much talk about the recession anymore.
Right.
So hopefully that this has been accomplished without forcing us into a hard landing recession and more unemployment loss.
Yeah, and I think that's what's interesting, right? The economic environment's pretty positive right now.
Sure.
Interest rates going down, equity markets up. There's lots of different positive spins on it. I think if you look, Florida, we're a little bit insulated because we have just that natural population growth from all the other states. But even if you look at the U.S. housing market in general, it's not negative.
Correct. Yeah.
And for a while, there's a lot of predictions that it was negative. I think the reality is it's not negative. It's actually doing fine.
No, it's not.
And so that's contributing to that overall perspective. So, we kind of talked through a lot of different things. Anything else we need to throw out there for our audience?
I don't think so.
Okay. That's good. I mean, again, I think it's because it's always nice to share perspective and forecast for 2024. I think it's important for people to know. But I predict it's going to be a pretty positive environment for real estate going forward.
And I think most economists would share. I think they're very bullish in 2024 with rates dropping. Financial sectors will do well. As you mentioned, 2023 was a great year for markets. 2024, they're hoping to be even more bullish as these rates drop. And I think that will stimulate even more buying activity. And we certainly anticipate 2024 to be a much better year.
Awesome, love it. Scott, as usual, thank you so much for being on the show. I really appreciate it. A wealth of knowledge in this, in the interest rate mortgage world. So we really appreciate it.
Thank you, Joel. Thanks for having me.
And thank you for joining us for another segment of Talking Trends. Till next time.